Well, hello everybody. It's June 5th. You're watching the Stock Market Brief Show where we help you navigate the financial markets through the lens of technical and intermarket analysis. And today's video I thought was titled appropriate because if you're watching the news or you're on socials, that is probably what you are led to believe. President Trump and Elon Musk are going back and forth and flaming one another on the social accounts, and it's causing all types of stock market volatility. Now, overall, the industries closed not horribly, right? The volatility index was up. S&P 500 was down 50 basis points. All the 11 sectors were basically down, except for communication services. And then the big laggard here was consumer discretionary. And that's coming from Tesla. Go figure, because Elon Musk is involved in this. And that stock alone, being one of the top holdings in the S&P 500 with a high implied volatility, can really start to drive market flow. And that's really what we saw today. So in today's Stock Market Brief Show, I kind of want to ease the feelings here. I want to show you something very interesting that I saw happen from an intermarket perspective today. I'm looking at multiple index products. We're going to talk about the updated expected moves and how today's move was all within expectations. I'm going to update you on the market conditions and talk a couple signal charts. We're going to get right into it today. Let's go. All right, ladies and gentlemen, welcome back. I can't not start with Tesla after the move that it had today. This is a large market cap name, a mega, right? One of the top holdings in the S&P 500. It was down 15% today, 14.26, but down intraday 17%. I got some interesting stats there as we're doing this big, beautiful back test over here on this prior breakout level. It was a large move with a large amount of volume. We got underneath that year-to-date VWAP, and also we're currently below the volume-weighted average price from the low of this year. So what does that tell us? As it stands right now, based off of this anchored volume-weighted average price, and obviously the year-to-date, it's telling us everybody from the year is now, in theory, underwater on average on Tesla. So we got to see if we can recoup this and it starts to make its way back up, and or if this is going to turn into something bigger. We'll talk about specifically some key levels in Tesla. You can see down here, this blue line, that is the 3 standard deviation weekly expected move, right? I don't usually put these levels out here, but I do the weeklies every week, and I give the 2 standard deviation moves. You can see we actually gapped down through that today. It held, right? So when the market gets it wrong, sometimes dynamic hedging kicks in, and once you start breaking from those levels, it can get really crazy. That's what we saw today, and it came basically spot on to that 3 standard deviation move underneath the declining 5-day moving average, well under the week-to-date VWAP. Can this bounce? Obviously, this can bounce off for these strong moves, but don't take it from me. Take it from Subu Trade, who did some cool research. I like every once in a while I'll post some cool stuff, but it says Tesla after an intraday drop of 17%, and what he called out here on this chart, it says historically has gained an average of 323% a year after similar one-day drops. But he also mentioned, don't bet the farm on that, and I couldn't agree more. When you approach the markets like this, you always got to pay attention to your position size, because when you hop into things like this, the only thing you can control is when you buy it, how much of it you buy it, and then obviously when you sell it. So you got to focus in there and just be aware that, moving into a product like this, when it's selling, it is like catching a falling knife. And if you don't have a strategy for that, if your strategy is going too hard, too heavy, too fast, I mean, we can move down another 5-6% and you'd be stopped out before maybe it bounces from there. So yeah, let's continue on. This is what I wanted to point out kind of from that intermarket standpoint. IWM finished up on the day, right? Now, small caps, they can be a confirming indicator in these markets at points. Seeing small caps actually hold up here leads me to believe that we could still have that type of rotation take place, right? People leave tech, then they start to look somewhere else, right? Sometimes that's risk off assets like utilities, like consumer staples, etc. But IWM and various small cap names have just not been loved at all. And today, it saw a little bit of hope, albeit it's not, withstanding and walking away from all the volatility that the rest of the market saw, which I'll point this out on the SPY and the Qs as well. But it was good to see them finish flat on the trading session. If you look at the daily time frame, we're kind of at this trend line. I'd have to mark it on another chart, but we're really kind of just drawing in this, what is known from a technical pattern. It's called inverse head and shoulders. And we're really getting kind of really tight here on the right-hand side. And this is the type of stuff I like, where if we can break through 210, you have a very clear area for where you'd manage risk. So you would back into it, right? This would be the risk. And then you could potentially break out and head further for making a pretty good risk to reward trade. So far it's holding up well, but we'll see if IWM does what IWM usually does and then just breaks down and heads lower. And that's the story there. But like I said, looks good so far. If we take a look at Q's intraday, this one was just these big three waves down over here before seeing a little bit of a bounce, selling up. But overall, pretty well-controlled trend line down here from an intraday 1-minute perspective. But you can see here these humps, a lot different than the shapes of the IWM. Now, I'm not surprised that the Q's are down 75 basis points and potentially may go lower, because we did talk about on the last market brief that we're outside of the quarterly expectations. And well, we still have this month left. So if we get positive news, we can go see the upper monthly implied move at about 555-ish. And then if we do get continued sell side, I mean, doodling around the quarter to date expected move, which is just under that 520 to 518 range, and that's pretty normal, right? We came way down here to the lower quarterly and bam, we're already up here at the upper quarterly. So this was a very sharp reaction from some sell side activities. So to see this come in a little bit, I mean, oh, shocking, right? But now if you take a look at the NASDAQ 100, take a look here on the daily time frame. Some people might start shaping this as a rising wedge pattern, meaning price action is getting very tight with a negative divergence here on both the percent price oscillator and the RSI. They might mention that we have an outside trading day with some volume. So this is a 2-bar reversal pattern, and it's, you know, unconfirmed at the moment, right? Or if it's invalidated, it would have to break back the high of today's candle. And then if you look a step further, you might notice, hey, the Bollinger Band is starting to trend lower here too and turn down, which can potentially result in price moving lower too. You might also look over here and say, oh man, we're stepping right on this trend line and barely holding on, which was pointed out on the last market brief that, you know, a steep trend like this doesn't obviously hold forever. And when it's broken, you can see sharp moves like, well, this was a pretty steep trend. We broke up, or you can see longer periods of consolidations as well. So that's what I'm seeing in big tech land. If you look at the SPY intraday, pretty similar story, just big waves of volatility overall, holding a pretty steady trend line, but overall fell well within the market's daily expectations. Now, when I say daily expectations, I give you these daily expected moves when I make a video, and then also in my Discord/Patreon channel. And the daily implied moves are derived by the options chain. And when you do so, you can think in terms of probabilities, right? So basically it's averaging out strikes that are, you know, below it, above it, and it's coming out and spinning out this number. It's averaging a bunch of strikes, all within the single day expiration. And then it gives us kind of that average here, just somewhat of an averaging formula. Okay. And it gives us this range, and this range of risk, you can think of in terms of a distribution curve, right? 68% of the time it'll close within it or tag it, right? It's typically more to tag it. And when you look at product like the S&P 500, very liquid product, or the SPX, right? The biggest product there. Actually, it's not quite like a normal distribution curve. It's typically more north of 70 to 75% of the time that will tag these levels and or close within it, at least from the weekly expected move perspective. And then I would say the daily one there too as well, just from my usage of these for the last few years. Okay, so yeah, overall, what are we doing? We're just kind of coming in. I'm going to update you on what that expected move is here too as well. And I'll show you the weekly chart. The weekly chart, oh, big deal, right? All that volatility, all that craziness. What are we doing? We're going sideways, still above a rising weekly 5 EMA. Oh man, what if we come back down to 58.50? Okay, cool. We're still at that rising 55 EMA, and we're still up on the week as it stands. Tomorrow, we do got some non-farm payrolls, unemployment rate. So what happens here? Implied volatility increases, which means we're going to probably get a bigger expected move for the day because the market's pricing in obviously more risk. Speaking of expected moves, let's get into it. You can see over here, this is the yearly chart. So for the year, right, 2025 is over here. Every orange line is the week, right? And you can see how it's kind of played within these weekly expected ranges. The blue boxes are times we closed outside of it. Currently, well within the weekly expectations. We're well within the month-to-date expectations. And we're right there near the upper quarterly expected move there too as well, after earlier coming down to it there at the beginning of the quarter. If I update you on the new daily expected moves, I do want to call out before I zoom in here that the lower daily vol range here, this daily expected move, is right at that last year's closing price. And I wanted to show you that once again because last year's closing price clearly has some memory to it. As you can see, it's held as a level of support and resistance. So if price were to come down here, right, it's likely to act as a level of support and or resistance if it's broken again, as we've seen through history, or I should say potential. Okay, now if I zoom in, what are those key levels? You can see over here, 587.33. I'm gonna actually just round this. I'm gonna say 587 to 586. Okay, that is the lower range. And if we start to break above and reclaim the week to date volume weighted average price, I would say that, hey, the opportunity to still hit the upper weekly expected move, albeit we did, I believe, hit it in the pre-market session today, is very possible still, given the context of how much volatility we have, right? Upper daily implied move is about 598, and the upper vol range is slightly above the weekly expected move. So we're, the door's open right now. But one thing that I do want to call out is this week to date VWAP held as support multiple times before breaking, and then it acted as resistance. So to feel more confident, I would like to see positive market net flow and then to reclaim some of those levels coming into tomorrow. Okay, market conditions. Where are we at? 6,000, still that key level. Watch the last video I posted, or if you haven't done it, watch it, or if you do remember it, we talked about how I don't really see price getting really too much through 6,000, and we mapped out some key levels that if it were to, it's likely to potentially come back in and get pinned around. Well, today we came right into 6,000 and we got rejected. Woohoo! Backwardation, no backwardation. We're in contango still on the VIX. So when people are all freaking out and stuff, you would think that, hey, we got more fear here now and less into the future. But as it stands right now, we actually see less fear, a little bit more into the future, which is more of a normal curve for the VIX futures. You can still see here, though, the current month, the front month, is at 20.95%. And then the next month out in August contract is 21.5. So we're not talking like a huge difference between the two. And it's still rather elevated. And that's fine. We are still holding above the gamma flip line. So volatility typically comes in or settles in, which we have been seeing. If we start creeping under the gamma flip line, back under that JPM short collar, and we start breaking from it, yeah, I would say watch out and be a little bit more careful, because when you're under the gamma flip line, that's when dealers start to sell into selling. They'll buy into buying, and you could see more intensive volatility, kind of like what we saw today. It kind of felt like we were under the flip line, but it just happened to be news headlines hitting the tape. This was that SPX 6,000 level over here. Today we came just into it. I think we missed it by 30 cents or so. But for whatever reason, if the market says, hey, this was no big deal, we overreacted, and then the price continues to press higher, just know that 6,000 is still that key level. And then our upper quarterly and upper monthly implied move is slightly there above us. And these levels can stall us out. So once again, I want to reiterate what I said on the last market brief. In and around this area for the remainder of the quarter is likely kind of where I see the highs for the month, just right around in this range, or potentially lower, which in another way you can interpret it like this. We're coming into an area where there's less reward to the upside than there is risk beneath us. Okay, so the risk to reward for the longs, for the bulls, it's getting slightly skewed. So when you approach the markets, understand that if this bigger market were to sell off, it can affect other names. If you get under the gamma flip line, you can still trade other stocks and everything, but you more likely will see more shakeouts, more fakeouts, more whipsaws. That's typically what happen. So just be aware of that. If I zoom in up here, you can see the levels a little bit clearer, how we kind of came right into that 6,000. And I do want to mark out this kind of confluence level over here, these two little VWAPs. If I pull it out, you can see this is the all-time high VWAP, and this blue line that's moving in confluence is actually the year-to-date volume-weighted average price. So I'm thinking here that, hey, if we slip under the gamma flip line, I might just be managing the positions that I currently have on. I'll get stopped out in some. If some work, awesome, cool. If I add new positions, they're going to be really good setups, because that's all I'll do in a swing trading environment. But I'd be looking for maybe a potentially quick flush down to potentially test in and around this level of confluence if that were to actually occur. As it stands now, we're still above the gamma flip line. We're just doodling around. We're at that very interesting inflection point right now, and we have minimal reward to the upside in the very near term. So you got to manage risk. You got to understand that, or try your best to understand that. I know a lot of people are like, well, is it going to go up or down? Because I need to know right now. Well, let me reiterate this for all those people that think that way. This market, trading, investing, swing trading, whatever you do, this is a market for people that are comfortable with managing risk in an uncertain environment. You will never have certainty in a marketplace like this. It just doesn't come. So you need to plan for possibilities because this game is all about probabilities. So you have to create, if this happens, then I'll be looking down here. If it doesn't happen, then I'll be looking for a move back up to 6,000. And if we start breaking it, maybe we'll look into higher levels where, if that were to be the case, then I would sell some more of the current positions I have on. If we were to break down, I would be managing the current positions I have on. If I get stopped off, then I'll still be looking to add positions, but when they set up properly. There's some if-then situations for you. If you take a look at the 5-day moving average across SPY, Q, IWM, and a couple other ones, pretty much green across the board. They're all inclining. We're seeing yellow form just a little bit here. So if we start breaking down, maybe we start seeing some red. But right now, they're all inclining. The majority of them are green, and we're starting to get a little bit of warning signs or neutral signs here on SPY, Q, and DIA. Let's look at some of the signal charts. Signal chart here for the NASDAQ summation index. I'm not going to reiterate what this is, but I talked about it on the prior market brief. You can see here we did cross over that parabolic SAR, and that can act as a potential change in trend. And then as far as the NASDAQ McClellan oscillator, pretty much a 0 reading overall, so nothing really given there. This I found to be kind of interesting. I like looking at the rate of change between growth and value. So I use IWF, IWD. So this chart right here, this little line is actually the Qs. This right here is the rate of change, 10-day rate of change between growth relative to value. So in short, what does this mean? When we start creeping up here above 5.0 on the rate of change, that means that growth is outperforming value at a pretty strong rate of change. When we start to cross down through the -5, it means that value is outperforming growth names. Sometimes you'll see divergences occur on the RSI and even the rate of change relative to price action in the Qs, and it's marked sometimes turning points. Another way you can use this is if it switches between positive and or negative by flipping in and out of that 0 line there. But I do want to call out that the market has been pricing higher, but we do have a subtle divergence in the rate of change. We'll see if that holds and it leads to something, but right now that is the current situation building out. On top of that, the NASDAQ composite bullish percent index, you can see here we have a subtle divergence building on the RSI, and you can see that in the bullish percent chart right here. We have a higher high and the RSI has a lower high. Price action also has that higher high, which can potentially lead to some consolidations and or pullback. Typically when you're above, above the 70 marker here, there's going to come a time where you're back below, right? And you're back to oversold. Right now, it's in an overbought condition with a divergence. Also to note, this I found to be interesting too. The S&P 500 is here. This is the percent of stocks above the 50-day and percent of stocks above the 200-day. And what I found interesting here was the S&P 500 was pressing higher, but yet the percent of stocks were actually decreasing. Percent of stocks were actually decreasing. What does this mean? It means markets pressing higher on fewer names, So it's an internal breadth indicator, you can call it, right? Telling us 50% of the stocks are above 67% of the stocks are above the 50-day moving average. That's what the current reading is. But over here, even more stocks were above the 50-day moving average, right? And then all of a sudden, there's less stocks above the 50-day moving average, but the price action is going higher. What gives? Well, one, it's a cap-weighted index, right? Two, it's telling us that their internals have kind of faltered a little bit in the near term. This also works great with positive divergences too, none that are currently on my screen at this moment. So I figured I'd point that one out. Another signal that I like to use is the Sailor to Shift tool. It did flip down through the signal line. Now it's only Thursday, so I have to wait for this to technically close. And then next week, right? So that would be the signal. If we close under this 0 line, the next week to get the trigger, we would have price to cross down under this candle's week as well. And then that would be the official trigger, which is kind of around that 100K marker right now, at least. We'll see what happens. And that would be that. And if we don't cross under this and it starts bouncing up higher, I just wait to see what the signal still says and move from there, and we'll continue to talk about it. But yeah, Bitcoin crypto came down quite a bit here, I guess, right? After a very big run up. This is not really a big sell-off by any means, at least right now. So we'll continue to monitor that one moving forward. Hope today's episode helps give you some insight into kind of how I look at these markets.